Banking sector results take on a different significance this quarter as the investment community still reels from the collapse of SVB. JP Morgan, Wells Fargo, and Citi are first out of the gate tomorrow. Former Goldman Sachs COO Gary Cohen gave us his take on the situation yesterday. Take a listen.
Lending conditions in the banking community are changing and changing quite rapidly. We've seen a lot of deposits move around the system. We've seen deposits move from small regional banks to larger banks, and then we've seen deposits move out of larger banks into money markets and treasury funds. So there's less money in the system to be lent out. Once banks have to hold their excess reserves, they can lend the remaining balances. But the remaining balances today at banks are relatively low. So the banks themselves are contracting the economy. The Federal Reserve Board understands that. I think they're trying to understand what the magnitude of that is.
And credit availability causing some debate in recent days. Treasury Secretary Janet Yellen this week said she'd seen no evidence of contraction in credit following the bank's failures. A different tone being struck by National Economic Council President Lael Brainerd in an interview with CNN. Earnings per share for the 6 largest banks in the U.S. is likely to slump around 10% from last year. That's according to estimates from Refinitiv. Our next guest says the biggest issue for banks will be their outlook, as deposit flows have taken center stage amid the recent banking turmoil. Let's bring in Nathan Stovall, S&P Global Market Intelligence Director for Financial Institutions Research. Nathan, thanks so much for joining us. So what will you be looking for with earnings that are kicking off tomorrow, and how significant are deposit outflows risks going forward?
Well, it's definitely significant, and it really is the number one issue. And what we're going to be looking for is what happened in the first quarter, but also what bank management teams say about what has happened since then. Because remember, they're watching these flows on a daily basis. And so we're going to look at how do deposit balances square against some of the data we've seen from the Fed, which shows that deposits have declined about 3% year to date. But as Gary Cohen said, we've seen stronger performance from the large institutions who've seen those declines around 2%, whereas banks out of the top 25 have seen declines around 4%. And the reason why that matters is exactly as he illustrated. It constrains their ability to lend. And so far, they have pulled back a little bit. We haven't seen severe constriction in credit. But if that picks up, that is deflationary. That is deleveraging in the economy, and that could lead to a little bit of a slowdown. But the real issue is going to be that banks are defending the cash that they have and defending it with higher rates on the deposit products they offer. So we're going to want to hear from bank management teams, how aggressively are they going after their depositors? What kind of rates are they having to offer to maintain the balances they have, keep the customers they have? Because the spread between bank deposit rates and the money markets has never been this wide. And we think that that's going to narrow. And that's one of the reasons why you see analysts expecting earnings to be down 10% year over year in Q1. And we think that number is actually going to be even larger throughout the year as those costs continue to grind higher throughout 23.
Right. So do they have any option besides increasing their yields on deposits? So, I mean, because why would somebody keep a deposit in a bank if they can get a better yield elsewhere? I mean, what recourse do they have?
Well, there's other reasons why people bank with a given bank beyond just yield. Now, there's no doubt about it that is a determinant in many customers' minds. But what other services is the bank offering? If I'm a commercial customer, am I offering treasury and cash management products? If I'm a retail customer, do I like the access to the digital services they offer, whether that's a mobile banking app, whether that's branch convenience? Do I have lending products with them, and as a result, they waive certain fees? So banks have other ways to retain and attract customers. And that's one of the reasons why they've been able to lag the increase in rates we saw last year so much year to date. But liquidity pressures were already building early this year. The 2 large bank failures we saw in March and the liquidity crunch that followed definitely accelerated that. So it is putting more pressure on them to raise those deposit rates. And one thing we've seen is while we've seen outflows broadly in deposit products, we've seen CDs, higher rate products, grow at a much, much faster clip. They're up about 20% year to date, and we think that that sort of mix shift will continue, and that'll be another big story of Q1 earnings.
Are you expecting to see a sort of big divide between what the big banks report and then what the smaller regional banks show? I mean, are we expecting the big banks to be the winners here?
I think you're going to see a couple of things. And yes, I do think you'll see a divide. I think the Fed data illustrates that the big banks have held up better, and they've seen a little bit of a benefit from call it to a flight to safety. So I think we'll see a little bit difference in terms of the way that they talk about their deposit business. But also they're going to be talking about what's happening in their investment banking business, which is a little bit different. The regionals, I think you're going to see some separation there in terms of haves and have-nots. Some companies that have been under more pressure, some banks have been able to maintain their business. And I think you're going to see some who haven't seen as much change, but have kind of been painted with the same broad brush. And then when you go down smaller, you could see kind of the same dynamic, where we've talked to a lot of community banks across the country who have said it's more business as usual for them. So one of the interesting things here is I think you're going to end up with a very different view of individual institutions post Q1. Because so far, yes, you have seen some underperformers and some modest outperformers, but largely the investment community has looked at the whole group with kind of a sense of fear. And this is going to provide us with a lot more insight into who has really come under greater pressure and who has been able to mitigate that pressure and kind of maintain business as usual.
And are we going to get any glimpse on lending standards? Have they gotten tighter, and have they gotten tighter within the regionals? Have the big banks also tightened their lending standards? I mean, are we seeing the impact of what has happened?
Yes, I think we will hear about that, and we have already seen that lending standards have tightened over the last few quarters. The Fed Senior Loan Officer Survey has said that on pretty much all lending products. That is going to be a big topic during Q1 earnings calls. No doubt about that, as well as the outlook for the economy and the prospect of a recession on the horizon. You know, most of the big banks had already baked in the prospect of a mild recession, not anything really severe. But one of the things that's interesting about this is while we've had this kind of liquidity crunch, the underlying economy has remained pretty strong. So the investment community is going to want to hear details on the health of the underlying borrowing base. I think banks will tighten standards. I think that they're going to be a little bit more careful with each dollar that they lend out. But investors are really going to want to hear greater detail on areas of concern, how those borrowing bases are holding up, and particularly around certain segments like commercial real estate, and within that, things like office.
And we saw what happened with regional stocks since the beginning of the year. They're still down year to date pretty heavily, double-digit percentages. Are we going to see M&A behavior among some of these regional banks?
I think eventually we'll get there. I mean, there's some headwinds to that around regulation, and I think people are going to wait for more detail on what new regulations could come as a result of this. You know, we think there's going to be more focus on deposit concentrations, deposit composition. Historically, it's been most on the loan side, so there'll be some changes there. But I think once the dust sort of settles and we get a little bit more clarity, the institutions that are more stretched from a liquidity perspective, I think will be much more motivated to look to partner with other institutions, while those who are a little bit more stable, I think absolutely could look at it as a way to sort of diversify maybe their lending base and perhaps even acquire somebody on the cheap. Right now, bank M&A activity is at historical lows, and I do think it'll pick up. But it's not going to accelerate in a big way really soon. But back half of the year, get a little bit more clarity on regulations, funding, and the economy. I think you will see some more transaction activity.
Nathan Stovall, S&P Global Market Intelligence Director for Financial Institutions Research. Thanks so much for joining us.
Thank you.